The Minority Market. Episode 20. Understanding Management and Moat Concept. When evaluating a company, many beginners focus on products, revenue, or market popularity, but often overlook two critical pillars of long-term investment success: management quality and the moat. These are the invisible forces that determine whether a business can sustain competitive advantage, weather challenges, and deliver compounding returns over time. Understanding these concepts is central to thinking like the minority. Let's start with management. A strong business can be destroyed by poor leadership, while an average business can thrive under exceptional management. Beginners often judge management based on charm, media visibility, or rhetoric. They mistake confidence and communication skills for competence. The minority evaluates management based on decision-making, consistency, integrity, and alignment with shareholder interests. Observing past actions, capital allocation, handling crises, strategic pivots, and operational discipline reveals patterns that numbers alone cannot show. Capital allocation is a key aspect. Management decides where and how resources are used, investing in growth, repurchasing shares, paying dividends, or taking on debt. Poor allocation can erode value, while disciplined allocation compounds wealth over time. The minority studies these decisions, asking, are resources deployed efficiently? Are risks considered? Is long-term value prioritized over short-term appearances? Beginners often ignore these questions, focusing instead on revenue growth or earnings reports. Transparency and communication are another measure of quality. Honest, clear communication with shareholders, employees, and stakeholders reflects management integrity. Avoiding surprises, acknowledging mistakes, and providing realistic guidance indicates a disciplined leadership team. Beginners often fall for narratives that sugarcoat reality. The minority values honesty, even when it is uncomfortable, over polished storytelling. Alignment of incentives matters profoundly. Are the leader's goals linked to shareholder success or personal gain? Stock options, bonuses, and compensation structures can create misaligned incentives, encouraging short-term thinking or risky behavior. Observing whether management's incentives match the long-term health of the company is essential for minority thinking. Next, let's explore the concept of a moat. Coined by Warren Buffett, a moat represents a company's sustainable competitive advantage, a protective barrier that prevents competitors from eroding profitability. Without a moat, even a well-managed company is vulnerable to competition, market changes, or technological disruption. Beginners often overlook moats, assuming that success today guarantees success tomorrow. The minority evaluates the durability and strength of the moat before committing capital. There are several types of moats. Brand moat is when customers trust and prefer a company's products over competitors, often allowing premium pricing. Network effect moat exists when a product becomes more valuable as more people use it, creating barriers for new entrants. Cost advantage moat arises when a company can produce more efficiently than competitors, protecting margins. Intellectual property, regulatory approvals, and exclusive partnerships can also form strong moats. Understanding the type of moat and its durability is crucial. A strong moat not only protects earnings, but also allows for compounding. Businesses with enduring moats can reinvest profits effectively, expand sustainably, and weather market fluctuations without losing advantage. Beginners often chase trendy businesses without moats, attracted by rapid growth or media attention. These companies may collapse when competition intensifies or economic conditions shift. The minority recognizes that slow, steady compounding from a protected business often outperforms flashy growth stories over time. Management and moat are interconnected. Strong leadership identifies, builds, and preserves moats. Weak leadership erodes them through poor decision-making, misaligned incentives, or lack of strategic foresight. When both are present, capable management, and a durable moat, the business has a higher probability of surviving cycles, generating cash flow, and delivering sustainable returns. This alignment is rare, which is why the minority mindset is crucial in identifying it. Evaluating management and moat requires observation, research, and critical thinking. Beginners often rely on headlines, analyst opinions, or superficial metrics. The minority digs deeper. They study annual reports, interviews, strategic decisions, and market positioning. They observe how management responds to adversity, competition, and innovation challenges. They assess whether the moat is real, defensible, and capable of lasting over decades. Behaviorally, this approach cultivates patience, discipline, and long-term thinking. You stop chasing hype or short-term returns and focus on structural advantage. You begin to understand why some companies thrive for decades, while others fade despite early success. By internalizing these principles, you develop an intuitive sense for quality businesses that can compound wealth over long horizons. Even small details reveal insights. How management treats employees reflects culture. How they prioritize innovation indicates adaptability. How they manage debt demonstrates prudence. By paying attention to these signals, you reduce reliance on numbers alone and develop a qualitative framework that complements quantitative analysis. The minority also understands that no moat is permanent. Disruption, technological change, and shifts in consumer behavior can weaken even the strongest advantages. Continuous monitoring of management decisions, industry trends, and strategic adjustments is essential. This vigilance allows proactive action rather than reactive panic. Finally, thinking like the minority requires synthesis. Evaluating management in moat is not about memorizing checklists or blindly trusting experts. It is about combining observation, critical assessment, and forward-looking judgment. By doing so, you prioritize survival, consistent compounding, and risk control over transient excitement or consensus thinking. In summary, evaluating management quality and moats allows you to separate companies that are likely to thrive over decades from those that may fail despite temporary success. This dual focus strengthens your decision-making, aligns your investments with durable advantage, and reduces vulnerability to common traps that ensnare the majority. Mastery of these concepts is a cornerstone of minority thinking and long-term investing success.